In January 2019, SoftBank marked its WeWork investment at $47 billion. By October 22, 2019, the same investment was marked below $8 billion. 9 months. One S1 filing. No new information that wasn't already in the company's records. That last part is the thing worth understanding. The information that destroyed the $47 billion valuation did not arrive in 2019. It had been in the financial statements for years. The losses were real and documented. The lease obligations were real and documented. The governance structure that gave Adam Neumann 20 times the voting power of any other shareholder was real and documented. The conflict of interest in which Neumann had leased buildings he personally owned to the company he controlled was real and documented. What changed in 2019 was not the information. It was the audience. Private investors had processed WeWork's financials through a specific frame. This is a high-growth community platform in an expanding market, and the losses are the investment required to build that platform at scale. Public market investors read the S1 without that frame. They read it as what it was: a real estate company with $47 billion in long-term lease obligations and a $1.9 billion net loss in a single year. Same numbers, different frame, an 83% drop in valuation. The WeWork story is almost always told as a story about Adam Neumann, his charisma, his excesses, his vision, and his eventual removal. That story is accurate as far as it goes. It misses the more instructive question: how did the frame survive as long as it did? How did a company losing nearly $2 billion a year sustain a $47 billion valuation for long enough that SoftBank's Vision Fund, Disney, J.P. Morgan, and Goldman Sachs were all inside the trade? WeWork's expansion was fueled by aggressive leasing and subleasing of office space, often on long-term leases while renting to members on short-term terms, and by unprecedented venture capital funding. By 2019, the company claimed roughly 500,000 paying members and hundreds of locations worldwide, but it was also burning through cash. The business model was simple and, stated plainly, not obviously viable at WeWork's scale. The company signed long-term leases, often 10 to 15 years, for office buildings, creating future lease obligations of roughly $47 billion across its portfolio. It then subleased that space on monthly or annual contracts, leaving the company exposed if tenants left in a downturn while its costs remained fixed. This mismatch, long-term obligations funded by short-term revenue, was not hidden. It was the defining financial characteristic of the company. Anyone who read the S1 could see it in the first 50 pages. Anyone who had read the private financials from previous funding rounds had access to the same structure. The scale of the raise tended to produce organizational confidence that substituted for the humility required to keep testing whether the underlying thesis was actually correct. By the time WeWork had raised $12 billion across its lifetime, questioning whether the thesis was correct had become institutionally impossible. The thesis was the valuation. The valuation was the story. And the story was what $12 billion of committed capital required to be true. Have you ever been inside an organization, or watched one from the outside, where the size of the financial commitment made questioning the underlying thesis feel professionally impossible? Leave a comment. WeWork had raised more than $12 billion in equity and debt financing across its lifetime and had never reported an annual profit. Its losses were accelerating, not narrowing. A $1.9 billion net loss on $1.8 billion in revenue in 2018. A company losing more than it makes in revenue is not a company with a growth problem. It is a company with a model problem. The model had been reframed as a community platform. The S1 filing revealed a series of revelations including huge losses, convoluted corporate governance with dual-class stock-giving founder Adam Neumann 20 times voting power, and conflicts of interest including Neumann profiting personally from building leases and trademarks. Neumann's personal outcome was striking. He received an exit package reportedly valued at up to $1.7 billion, comprising up to $970 million for his shares, a $185 million consulting fee, and $500 million in credit to repay personal loans. The 2,400 employees who were laid off, approximately 19% of WeWork's global workforce, in the weeks after the IPO withdrawal, did not receive exit packages. They received termination notices. The same collapse that produced a $1.7 billion exit for the founder produced layoffs for the people who had believed in the company enough to build it. This asymmetry is the human dimension that the standard WeWork narrative, focused on Neumann's personality and SoftBank's judgment, almost always skips. If the specific mechanism, How a financial frame applied to a losing business sustains a valuation, until a change in audience removes the frame, is what makes this channel worth your time. The like is the direct signal. The WeWork investors who held through the S1, the private funds, the strategic corporate investors, the individuals who had committed capital across multiple rounds, experienced the collapse as a mark-to-market event. Their positions declined in value. The decline was real. For most of them, it was not existential. The 2,400 people who were laid off experienced the same event as a job loss. For many of them, that loss was preceded by equity grants that had been part of their compensation, equity that was now worth a fraction of what it had been promised to be worth when they accepted the role, or nothing, depending on the terms of their specific grant. Adam Neumann, in his first interview after 2 years of silence, expressed regret but stopped short of apology. "It was never my intention for the company not to succeed as much as it did," he said. "The intention is not the mechanism. The mechanism is what happened in the financial structure. The long-term lease obligations that fixed the costs, the community frame that inflated the valuation, the governance provisions that concentrated control, and the capital inflows that made questioning the thesis feel like the wrong position to be in. Each of these was a documented, visible, disclosed element of the WeWork story. Each of them was processed through a frame that made the disclosure feel like detail rather than diagnosis. The practical thing, in short, by mid-2024, WeWork had gone from a 47B unicorn to a restructured startup with roughly 750 mailers post-bankruptcy valuation. The specific analytical question the WeWork case produces is not, how did Neumann fool everyone? Most of the people inside the trade were sophisticated. The question is, what conditions cause sophisticated investors to process available financial information through a frame that makes the underlying model's problems invisible? The conditions are specific and repeatable. A charismatic founder with a credible vision of a genuinely large market, an anchor investor willing to mark a very high valuation that creates social proof for subsequent investors, a language of transformation that makes the standard financial analysis feel like a failure of imagination, and a round size that makes reversing course feel more expensive than continuing. Those 4 conditions were all present in WeWork. They are present in every large-scale valuation collapse that follows the same structure. The information is always there. The frame is what determines whether the information is diagnosis or detail. The next episode looks at a company that had the same information problem in a different market, and where the collapse came not from a single S1 filing, but from a slow, documented, and consistently ignored decline in the one metric that should have been the most important signal of all. This content was developed with the support of artificial intelligence tools and underwent human review, editorial curation, and approval before publication. The analysis presented here is strictly educational and philosophical in nature, grounded in behavioral psychology and classical stoicism.